The dumping began exactly the way it always does. Cold, mechanical, emotionless. Algorithms fired first, flooding the COMEX with waves of sell orders designed to create panic, to trigger stop losses, to convince the market that gravity had returned. The price dipped on cue, just enough to scare weak hands, just enough to make the charts look familiar. But then something happened that was never supposed to happen. The fall stopped. Not slowed, stopped. As if silver had hit an invisible concrete floor. Out of nowhere, a wall of buying power emerged, orders so massive they didn't just absorb the selling pressure, they annihilated it. In seconds, the red candles flipped green. The dip wasn't just bought. It was devoured with a level of aggression the market has not seen in decades. By the time the closing bell rang, silver hadn't merely recovered. It had exploded through the critical resistance level at $67, a level that had acted like a ceiling for years. This was not a fluctuation. This was not volatility. This was a signal flare visible across the entire global financial system. It marked the failure of the Friday smash, the single most reliable manipulation tactic in modern market history. For the first time, the beast didn't just miss, it bled. To understand why this failure is so dangerous, you have to understand who was pulling the lever and why it mattered so much. At the center of this system sits J.P. Morgan, acting simultaneously as the custodian of the largest silver stockpile in the Western world and the primary suppressor of its price. Their power comes from a simple but lethal mechanism: naked shorting. They sell contracts promising to deliver silver they do not possess, betting that the price will fall so they can buy those contracts back later at a cheaper price. It's a game of musical chairs played with millions of ounces. As long as the price goes down, the music keeps playing. But when the price rises instead, the math turns brutal. Every dollar silver moves higher translates into billions in losses for those holding short positions. There is no escape hatch. Yesterday's failure to force the price down trapped J.P. Morgan in a corner. They are now holding a rapidly expanding bag of toxic liabilities, a position that grows more dangerous with every passing hour. They tried to bluff the market. The market called that bluff and raised the stakes. Now they're standing on the tracks, staring at headlights, and the train isn't slowing down. That brings us to the most dangerous moment of all: Monday morning. While markets are technically closed over the weekend, panic doesn't respect business hours. It is already spreading through private dealing rooms in London and Hong Kong. When Asian markets open on Sunday night, which is Monday morning in the East, the probability of a violent gap up is extremely high. A gap occurs when there are simply no sellers at the current price. The market doesn't climb, it teleports. Silver doesn't move from $67 to $68. It jumps to $70, then $75, almost instantly. For banks sitting on massive short positions, this scenario is nothing short of apocalyptic. Margin calls begin immediately. More collateral is demanded to cover losing bets. If that collateral can't be produced, the exchange steps in and liquidates the position automatically, forcing banks to buy silver at any available price just to close out. This is the anatomy of a short squeeze. We've seen it before with GameStop. We've seen it with Volkswagen. But silver is not a meme stock. It is a strategic metal embedded in the global industrial supply chain. A squeeze here doesn't just bankrupt traders, it fractures manufacturing, energy, and technology systems worldwide. What yesterday proved beyond any doubt is that the physical silver market has finally decoupled from the paper market. For decades, the price of silver was dictated by men in suits trading digital promises in New York, completely disconnected from real-world supply. But that illusion shattered when industrial buyers, companies like Samsung, Tesla, Apple, and massive Chinese solar manufacturers, stopped caring about paper prices altogether. They don't need contracts, they need metal. and the vaults are empty. While banks were dumping paper, these industrial giants were standing for delivery, demanding real silver. That's why the price didn't collapse. You can print unlimited paper contracts, but you cannot print a 1,000-ounce silver bar. The illusion of abundance has collided head-on with the reality of scarcity. The paper market claims silver is worth $67. The physical market is screaming that it's priceless because you simply cannot find it. While the West continues playing financial games, the East is draining the board. The Shanghai Gold Exchange has been trading silver at a persistent premium over New York for months. This arbitrage acts like a vacuum cleaner, sucking physical metal out of Western vaults. Every ounce mined in Mexico or Peru increasingly bypasses New York entirely and flows straight into China, because China is willing to pay more. Yesterday, those purchases accelerated dramatically. Chinese buyers know Western banks are vulnerable. They know JP Morgan is under pressure. By aggressively buying the dip, China is tightening the noose around the Western financial system, forcing a potential default on Western exchanges. This is not just a trade. It is economic warfare. China is cornering the technology metal of the 21st century, using Western corruption as the weapon against itself. We already have a blueprint for what happens next. Look at the nickel squeeze on the London Metal Exchange in March 2022. A massive short position went wrong, prices doubled in hours, losses reached billions, and instead of allowing the market to function, the exchange simply shut it down, canceled trades, and rewrote the rules to save insiders deemed too big to fail. Anyone who believes they won't attempt the same thing with silver is dangerously naive. As we approach Monday, the risk of a force majeure event or a trading halt is at an all-time high. Banks will not quietly accept their losses. They will try to flip the board. But this time is different. Nickel is an industrial input. Silver is money. If the silver market breaks, confidence in the US dollar breaks with it. The system is trapped between hyperinflation and default, and neither path is survivable. The technical setup only makes the situation more explosive. The options market has created the conditions for a gamma squeeze. Speculators have loaded up on call options, betting on higher prices. Banks sold those options. As silver approaches key levels like $70, those banks are legally required to hedge by buying physical silver. The higher the price goes, the more silver they must buy, which pushes the price even higher, forcing even more buying. It is a self-reinforcing feedback loop from hell. The Friday smash was an attempt to escape this trap. It failed. Now banks are heading into the weekend knowing that on Monday, they themselves may become the largest buyers in the market, buying directly against their own survival. Markets are driven as much by psychology as by math, and the psychological shift may be the most dangerous part of all. For over a decade, silver investors were trained to expect failure. Every rally was smashed. Every breakout was sold. Fear dominated. Yesterday changed that. Fear of missing out has overtaken fear of loss. When a market stops responding to manipulation, it signals a trend change that cannot be stopped. Retail investors, institutional funds, and even sovereign players now smell blood. They know the predator is wounded. And when belief shifts collectively, it becomes self-fulfilling. If everyone expects higher prices and no one sells, price has no ceiling. The myth of the all-powerful banker has been shattered. Now we confront the question no one wants to ask. What happens if silver hits $100? At that level, the liabilities of major bullion banks exceed their Tier 1 capital. In plain language, they are insolvent. The only solution becomes a bailout, trillions printed by the Federal Reserve. That money printing fuels inflation, which drives silver even higher, locking the system into a death spiral. JP Morgan's short position is no longer just a bad trade. It is a systemic threat. The entire Western financial system has been leveraged against a metal that cannot be created at will. Monday is not just about silver's price, it's about the solvency of the banking cartel itself. Lose control here, and the contagion spreads to gold, to bonds, and ultimately to the currency. That leaves you with roughly 48 hours before Asian markets open. The Friday smash failed. Suppression is ending. The beach ball held underwater for decades is breaking free. The $67 price on your screen is a ghost, a legacy number. It may be the last time silver ever trades in the 60s. When markets reopen, price discovery begins. What's coming isn't a prediction. It's a mathematical consequence of failed intervention. The banks are out of ammunition, the vaults are out of metal, and time has run out. If you're not holding the physical asset when the bell rings on Monday, you won't be participating in the greatest wealth transfer of a generation. You'll be watching it happen from the sidelines.